Political uncertainty often feels like a threat to markets. Elections, leadership changes, policy debates, and geopolitical tensions dominate headlines and create a sense that instability must lead to falling stock prices. Yet history repeatedly shows that markets do not always decline during periods of political uncertainty. In many cases, they rise, remain stable, or recover quickly after brief volatility. To understand why, we need to separate how politics feels from how markets actually work. Markets are not emotional observers of political drama. They are systems designed to price future economic outcomes. When political uncertainty appears, markets do not ask whether the situation feels chaotic. They ask whether expected corporate earnings, cash flows, and capital conditions are likely to change materially over time. If uncertainty does not meaningfully alter those expectations, markets often remain resilient. One key reason political uncertainty does not always lead to losses is that markets are already accustomed to it. Political disagreement, elections, and policy debates are recurring features of modern economies. Investors know that uncertainty is not an exception, it is the baseline. As a result, much political risk is already priced in long before headlines appear dramatic to the public. Markets also distinguish between noise and structural change. Daily political rhetoric, campaign promises, and short-term controversies generate attention but often do not translate into immediate policy action. Investors wait to see whether uncertainty leads to concrete changes in taxation, regulation, trade, or monetary conditions. Without implementation, uncertainty remains theoretical rather than economic. Markets react to actions, not arguments. Another important factor is that political uncertainty can delay harmful decisions. When governments are divided or leadership is unstable, sweeping policy changes become harder to implement. From a market perspective, gridlock can sometimes be preferable to aggressive intervention. Investors may interpret political uncertainty as a signal that extreme policies are unlikely to pass. In this way, uncertainty can reduce downside risk rather than increase it. Liquidity also plays a powerful role. Even during politically uncertain periods, central banks often continue to support financial systems. Interest rates, liquidity provision, and financial stability measures frequently outweigh political developments in determining asset prices. As long as liquidity remains available, markets can absorb political shocks more easily than expected. Money flow often matters more than political headlines. Corporate adaptability further explains market resilience. Companies do not wait passively for political clarity. They adjust pricing, diversify supply chains, shift investment plans, and manage costs in response to uncertainty. Markets recognize this adaptability and often maintain confidence in corporate survival even when political environments are unclear. The ability to adapt reduces long-term earnings risk. Political uncertainty can also create asymmetric expectations. When sentiment is pessimistic, expectations are lowered. This means that outcomes do not need to be good to support prices. They simply need to be less bad than feared. When reality turns out to be manageable, markets often reprice upward. Markets move on the gap between expectations and outcomes. It is also important to recognize that political uncertainty is rarely uniform across sectors. Some industries may be exposed to regulation or government spending decisions, while others are largely insulated. Broad market indices often reflect the strength of less affected sectors, even while specific stocks experience volatility. Political risk is usually selective, not universal. Another reason markets often hold up is that long-term investors focus on structural trends rather than political cycles. Demographics, technology, productivity, and global demand evolve over decades, not election cycles. Institutional investors frequently look beyond short-term uncertainty and maintain exposure based on long-term theses. Their presence stabilizes markets during periods of political stress. Time horizon matters more than headlines. This does not mean political uncertainty is irrelevant. Markets can and do react negatively when uncertainty leads to real economic disruption, such as capital controls, nationalization, trade breakdowns, or fiscal crises. But uncertainty alone, without clear transmission to earnings or liquidity, is often insufficient to sustain market declines. Fear alone does not move markets indefinitely. In summary, political uncertainty does not always mean market losses because markets price future economics, not present drama. They distinguish between noise and action, rely on liquidity and corporate adaptability, and respond more to expectations than emotions. While volatility may increase, long-term market direction often depends on factors far deeper than politics. Understanding this helps investors avoid reacting emotionally to uncertainty and instead focus on how political developments actually affect economic reality.